These macroeconomic charts will blow your mind because they say exactly what is going on in our economy. So let's dive in. Things are falling apart truly. Small business optimism lower than it was during the pandemic, right? It's hard to think of a time worse than that economically in 2020, getting to where it was in the great financial crisis. So people are feeling pressure. Small businesses very pessimistic about the future. Bank failures by year. We have more bank failures in assets than during the great financial crisis, right? So clearly not painting a great picture at this time. Now, why is all this happening? Because the Federal Reserve is hiking interest rates, which are the oxygen of the financial system. They're hiking interest rates to crush inflation because that's going to slow down the economy. People are going to spend less money. That's the theory behind it. And so this chart is showing median CPI, which measures inflation, and NFIB price plans. And so what everyone is waiting for is for median CPI to come down because that measures inflation. Well, we're already seeing NFIB price plans falling. Price hikes not planned anymore, going right back down to the mean, and the CPI follows. And so the Federal Reserve is hoping they're doing enough to bring inflation down so they can eventually stop crashing the economy and lower interest rates ultimately, which will be very good for the risk assets. Here is the issue. 1 month US Treasury yield spiking massively to a recent high of 5%. The failure of SVB caused that dip in 2023 that caused a rally in risk assets, and the yield came down. Well, that just went right back up. This is the wrecking ball. This is crashing everything. This is what's causing all the devastation. Well, it's hitting a recent high, right? Going back up. Inflation now expected to remain sticky. So what does that do to the economic devastation these high interest rates are causing? It causes it to get worse because interest rates are rising to compensate for the higher inflation expectations. And so this chart says everything. At the end of the day, the Fed funds rate in orange has to be higher than inflation in order to truly stop inflation. This is why Paul Volcker in the 1970s is a hero economically, because he raised interest rates higher than inflation, which truly crushed everything. And that is what ultimately killed inflation, right? Well, the Federal Reserve of today is not doing that. They have kept interest rates lower than inflation, right? And that has still caused the economic devastation we're seeing. So interest rates are lower than inflation. What does that mean? It means that as long as you're buying an asset that appreciates higher than inflation, then it's okay to take out a loan at the interest rate that is below inflation, right? So if inflation's 6% and you take out a loan at 4% and you get a 6% return on your asset, then who cares if you're paying a 4% return? So the Federal Reserve has been too shy to truly do what it takes to crush inflation. Now, unfortunately, this could end up in a stagflationary spiral where the Federal Reserve will have to be heroic and actually raise interest rates. The problem is we're in a massive bubble driven by 0% interest rates for the last few years, right? Whenever they try to raise rates a little bit, try to be heroic, the economy crashes. We're already seeing that happen. The problem is inflation is sticky. They're going to have to be heroic, really raise rates higher than inflation in order to bring it down. And right now it seems that there's economic devastation. We're going to have to wait and see what happens with inflation. If stagflationary fundamentals exist in our economy, then expect more devastation, not only in the economy, but in risk assets, stocks. Now, if inflation does roll over, if the Federal Reserve gets its wish, then we'll finally have the tools to pump the economy and all stocks and assets back up, right? Debase the currency even more, pump up this market. Thank you guys for watching. I appreciate you. We're going to still spend our time buying up these extremely high quality assets for the long term, because at the end of the day, they're going to debase the currency. Assets denominated in these currencies are going to go up in value because the denominating currency is going down in value. That is the game. That's why assets have skyrocketed over the last few decades / centuries. And so it's not going to stop. Every inflationary economy like Venezuela has its stock market spike because the currency comes down. The beauty of what we get to do right now is pick up the highest quality assets that can actually outperform the debasement of the currency. That is the goal. That's what early stage investors are doing. And we're going to have to stay on top of this market. This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.